Greetings and thank you for being with us on You and Your Money. I'm Bryan Hirsch, and this evening we're focusing on investments. Before dealing with an insightful discussion with David Shapiro, I would like to make some comments on the TwoPot system that was implemented to start yesterday. Many of you have read and been exposed to the TwoPot retirement system, and I have the following comments. It should not be used to go on a spending spree, but only used for those who are struggling to pay off debt. I'm not going to discuss the pros and cons, but as many of our viewers are employers, they may be asked questions by their employees about it. And the first thing is, to make use of the withdrawal facility, you will have to get a tax directive on the maximum, which is available, of 30,000. One will be taxed at marginal rates. In other words, the withdrawal will be taxed between 18 and 45%, depending on your earnings. And then thirdly, if you're in debt to revenue for any funds, this amount will be deducted from the withdrawal. As an employer, these are the critical points that I think you should point out to any of your employees that may ask you for advice. And then, as I said, joining me this evening is David Shapiro, Chief Global Equity Strategist at Sept and Wealth. David, good to have you on the show.
Yes, sir.
David, the TwoPot system, their expectations is in excess of 1 million people are going to make use of it, and our tax revenue are going to get a boost in terms of the tax, as I said. How is this going to affect markets? And then going forward, David, pension money was invested. Now only 2/3 of that future pension money is going to go into pot 1, which is for retirement, and the 1/3's got to be retained in case you want to withdraw on a yearly basis. So is this going to have any impact in terms of turnover and anything you could see happening?
We don't know. We actually don't know. No one can calculate with any certainty how this is going to affect us. I think what is going to affect us is that, despite what you say, and I think what you're saying is absolutely correct, be careful about withdrawing this for frivolous needs. Frivolous is maybe a bit harsh, but in other words, if you really need the money.
For people who want to spend it.
You know what worries me is that it's going to go in the wrong area, not for essentials. I think this is why it was created, if I'm right, and I'm not an expert in this area, but I remember during COVID when people were really battling, they wanted to allow them to withdraw on their pensions. I think this is the genesis of this, the TwoPot system. But it is going to give the market a boost. It's going to give the economy a boost and the fiscus a boost, because huge amounts of money are going to spend, even if it is to ShopRite or to Pick and Pay and so on. I think people will use this, and we're going to get a boost. But Bryan, we don't know. We don't know how much it's going to be. And I think the larger pension funds, those that have been well established, I think are not going to be affected by this in terms of having to adjust their asset allocation and so on. But we're going to find out just down the road.
But David, one thing we do know for certain, future contributions,
yes.
2/3 can go into the market.
Yes.
1/3's got to be retained in a different pot
yes.
for people who on a yearly basis can withdraw that money. So as you say, we don't know what's going to happen on the vested portion,
right.
which is the 10% that you can withdraw up to 30,000 Rand,
yes.
and that's taxable.
Yeah.
But going forward?
Well, that's also, you're going to have to derive a new kind of strategy for this money, which may be short-term or may be able to be drawn, at least once a year. So what do? Do you put that, use the same asset allocation for your investable amount or not? It's going to be difficult. Each pension fund is going to have to devise its own strategy.
Yeah, what amazes me, we've had so many discussions about preservation. And this new dispensation
yes.
just came in where people under the age of 55, their future contributions, 2/3 are not going to be able to withdraw until retirement.
Yeah.
And I don't think that's been fully understood by the individual employee.
Bryan, I hope along the way people are flexible, or the authorities are flexible and know where they've gone wrong. Like any new legislation, I think there's got to be a way open to adjust and to amend.
Okay, so now let's move on to
yes.
the big event last week. The whole world, the whole economic world, the whole investing world were focusing on Nvidia's results. How can it be possible that we had the discussion at Jackson Hole about what was going to happen in interest rates, which was a big factor for markets, and then last week the whole market was focusing on one share?
I know. It's crazy. I don't know why it's become such an obsession with people. It's a good business, and it's an appropriate business. It's a business who makes the appropriate chips for artificial intelligence. And the kind of chips that they make at the moment are far ahead or far more useful than anything else that's on the market. And of course the share price has responded to it. But when you go into the actual numbers, the share is not expensive, even though it's grown, because you have to look at their sales. But Bryan, my argument against the detractors, because to be honest, I'm very positive on it, and I maintain my position, and especially at these levels. But the big argument, and this is something for people to understand, with a growth company, if we went back 3 years and you look at what people were forecasting for Nvidia, no one got it right. They were far, far under what the company would produce, because at that stage we were still in COVID, no one knew this business. So what I'm trying to get at in a simple way is that we don't know where this company is going to be in 3 years. We can't look at current sales and try and project them on a linear type basis. So, my point is, okay, let's watch what the company does, but you don't have to get emotional about it, and wanting to short it, believe that it's going to go to, incredible heights. Just, it's a business. It's just like every other business. Just watch the results, and you can make up your mind on a quarterly basis.
So,
but
David,
that's a good business.
That leads me to the next question.
Yeah.
I mean, you focus on market performance, and markets go up and down,
Yes.
and corporate performance.
Yes.
So when it comes to making that decision,
Yeah.
obviously you focus on the company and
Yes.
and how solid the company is, and then market is risk.
That's exactly dead right.
You don't take any risk with corporations.
No.
Although all South Africans took risks with Steinhoff.
Yeah, and there are lots of people. There's, you know what worries me or bothers me about the market? We underestimate the level of speculation in it. I'm talking on a global basis. Because you've got derivative markets, you've got options. And remember 2008, or if you go back even further than that, the massive speculation that there was in property with the subprime market and the collapse that it led to in 2008 and 2009. I'm not suggesting anything's going to happen, but people never learn. Slowly you're finding more and more kind of products entering the market. And again, I say on a global basis, this is not directed at anybody locally, where the levels of speculation are quite incredible. And the kind of products that are derived using derivatives, even in the ETF space, the ETFs where you can buy derivatives. So you've always got to watch for that. You've always got to be aware of what's happening in that market, because it can swing share prices, backwards and forwards. And that's why I like to look at the underlying business and say, okay, what are they doing? What are they making? Is it still relevant? Have they got money in the bank? And all the other metrics that we apply. So you're dead right. You've got to learn to also know what's noise and what's not noise.
So that makes it quite difficult on a daily basis. I mean, it's an amazing thing. I've always said people buy property for long term.
Yeah.
They never look at the value each day. They buy shares for long term and they watch them daily.
Not daily. They watch them minute by minute.
Okay.
In front of them, they've got their wealth.
But today,
all
the companies are reporting at the end of July. End of August. I didn't realize we're into September already.
No.
But the end of August, what happened? And that's not really how you should be evaluating your portfolio.
Bryan, I always say, for us, as asset managers or people who look at the market, it's not difficult to choose good companies. What's difficult is to manage the emotions of your clients and customers, because it goes up and down and up and down. And I always, when we're on programs like this, people say, I want to buy something for the 5 years. I say, no, you don't. They don't want to buy it for 5 years because they're not going to hang around for 5 years.
They want to buy instant gratification.
Yes. They're going to watch it on a minute-to-minute basis.
So what are the common mistakes that you've seen? I mean, David, you and I have been around. Collectively, you and I have had more than 100 years in the market. And you're just a junior to me. But David, what are the type of mistakes that you identify and you can get the message across, not to allow investors, not traders, investors to avoid these mistakes?
It's only in time do you realize how clever Mr. Buffett was or is still. And that, they always used to say, don't look at the market. Look at it once a year or something. And I think there's a lot of wisdom in that. I think you can drive yourself mad, looking at the way that markets move on a daily basis. And a lot of that is swayed by professionals. Professional speculators, professional, fund, hedge funds. And hedge funds are nothing more than trading funds. They're not really hedge anymore. So I think that's the big mistake that people make, is that they become too emotional, instead of focusing and looking for good products. And, I had a discussion this morning on the whole thing, looking at portfolios. And the more I look at the companies in which we're invested, the more happy I feel, despite the fact that there are things happen. Just buy good businesses. And we can go into that, what makes a good business. It's not very difficult for us to establish that.
David, has AI investing lost its glitter?
No.
This month of August? Because the market started off with these companies where they were looking at the expenditure and nothing dropping to the bottom lines yet.
You don't realize it will start to drop. The problem is, there again, we want instant gratification. AI, in the way that we know it, only became publicly used or available to the public or to the general, I suppose you can call it, even to practitioners, in November 2022, which is not even 2 years ago. But every day something new is happening. I use it extensively, and it saves me hours. Now, I'm not even using it in a way, in a very professional or in a very sophisticated way. But have a look at some young kids. Have a look at how they're using it on their phones and that. So it's in the build-out stages. It's still in the build-out stages where you're building the architecture or infrastructure for people to use it. And that's where the money's being spent. But sooner or later, you're going to be able to actually use it for what it was meant to do. They're still developing the learning products. And eventually, you're going to be able to use that data for whatever profession you're in. So it's still very, very early.
Well, we're going to take a short break. Stay tuned. We'll be back shortly.